Hello and welcome to Switzer TV. I'm Peter Switzer. Thanks for joining me. On the program tonight, I've got Wong, the fund manager from Prime Value, and he's going to give us his best 3 stocks for 2023. And then Adam Dawes of Shaw and Partners is going to look at the stocks that he's chasing and dumping right now. And I talked to him about whether tech's going to make a rebound sometime this year. And then Ben Finger from a company called Haven Property Fund. And this company actually invests in shopping centres, ones that look unloved, and they revamp them and turn them into very successful operations, and they eventually sell them off. And people can invest in this kind of thing. It does promise high returns, but of course high returns always means there's more risk than investing in a government guaranteed term deposit. But a lot of people find these kinds of investments interesting. So that's the show for the night. Let's kick off now with Adam Dawes of Shaw and Partners. Thanks for joining us, Adam.
Great to be here.
So, Adam, let's just take a look at your outlook for investing this year. And I was watching CNBC over the weekend, and Tom Lee from Fundstrat is one of the most optimistic people in the world. He makes me look like a pessimist, I often say. And he thinks that March and April will be pretty good for stocks, and he thinks that the US will start showing greater signs of inflation falling. Is that what we need to keep this market heading up?
Well, yeah, absolutely. And just confirming that, Peter, that's not Tommy Lee of Motley Crue.
No.
Right.
No.
So we are talking about the same person here.
Yeah. This is Tom Lee.
Tom Lee.
It's good to see I've got an intellectual market commentator on the program. But so getting away from rock legends, what do you think? Do you think even if March and April don't turn out to be good, are you thinking second half is probably going to be better than the first half?
It would be interesting. In Australia, I think that second half is going to be a little bit tougher due to most of our resource companies have guided to the second half being a little bit softer, lower dividends, and that kind of stuff. So I think our market potentially might struggle a little bit more due to the fact that we are quite resource driven, or we do have a large component of resources in our index.
Yep.
However, I did read that article today and had a bit of a look about it. He's talking about softer inflation numbers, as you mentioned, and I certainly do think that CPI number in the US will start to continue to come down. However, it will be quite sticky. And whether that's at, it probably won't be at that band of 2 to 3% where the Fed wants it to be. It probably will be a little bit higher, and it's just going to stay sticky for a little bit longer. Potentially that could unnerve markets as well, because with the blunt instrument that is interest rates, trying to bang it on the head to get it down there, it's just going to take a little bit longer than expected. So I'd be cautious there. The other side of it is that we have started and earnings season has finished. We have now seen that there was 60% misses versus 40% beats, and generally earnings has now started to fall away, but the market is still staying somewhat frothy or lofty at these levels, and we know that earnings do drive markets going forward. But at the moment, it seems that sentiment is driving our market versus earnings. So earnings aren't driving our market, it's sentiment. And as you know, sentiment can turn on a dime if there is some bad news out there. So I really liked his optimism. I really liked the way that he thought about things. And yes, CPI is going to come down, so that will support our markets. But I'm just a little bit concerned about this earnings and how that earnings has fallen away, but the markets hasn't really followed. So I'm in the camp that I'm cautious going into the second half of this year.
Yeah. I'm just thinking that at some stage, it's interesting you bring up the fact that resources will be a bit softer. Also, I think the banks will be too, because interest rates will have peaked by then. And, and we have all those stories about the mortgage cliff and all that sort of stuff. But effectively, CBA's talked about rates falling, good for the stock market. And also, there's that rotation we've been hoping for. Like if I'm a big fund manager and I've made a lot of money out of BHP and CBA and NAB, I'd probably be looking at some of the good quality small cap tech stocks that have been really belted up And let's just take, I often talk about Megaport. It was $20 odd, it's now what, around $5. Even if I made $1 on Megaport as a fund manager, I'm making 20%.
Yeah, absolutely. And we actually did see, just talking about post-reporting season, WiseTech was one of those outstanding companies that reported really well. And there were some other good quality tech names that actually sort of beat estimates.
Yeah.
And so I think that's really important for the sector, is to have that tailwind, or at least that confidence that they're going to be moving forward. So yeah, tech certainly looks good. Look, the banks, I think, have had a really great time with quantitative easing and obviously low interest rates and mortgages. But, there's anecdotal evidence out there that CBA is writing loans now that are more expensive than what their net interest margin is. And that's really just due to competition. There's so much competition out there. They're wanting to keep their market share, and potentially they're writing loans that aren't so profitable these days. So yeah, it'll be a tough space in the banks as well, as that net interest margin continues to get squeezed.
Okay, I've asked you all the easy questions. Now, some tough questions. Give us a stock that you really like right now that you're talking to your customers about.
Yeah, so we're looking at a couple of ones, and obviously higher interest rates, meaning that the consumer discretionary space is going to get very, very tough of late, and will continue. And I don't think we've really seen that. But there's a lot of talk of customers trading down. So in other words, if you would go and buy your pair of jeans at Just Jeans or and I'm not the fashion label that I should.
We know that. Yeah.
Give you the high-end fashion.
Yeah, right.
But it's thank you. Instead of buying that $200 pair of jeans, you potentially might go to Kmart or Target and buy yourself a $10 pair of jeans.
Okay.
So there's this whole talk about this sort of trade down cycle, and I really like at the moment. I'm talking to clients about Woolworths. I think consumer staples, they will continue. Yeah. Basket sizes will have to increase, so that'll be good. Wesfarmers we really like because of Kmart, Target, those kinds of things, talking about that pair of jeans and trading down, and still having to buy shoes, still having to buy apparel, still having to buy things for the house and the home. As well as then, I really liked Endeavour as well. We're buying some more Endeavour. I thought the result was fantastic. A little bit of an earnings upgrade there, but I still think that Endeavour is one of those ones where times get tough, people will turn to those naughty things like gambling and alcohol. So it's Wesfarmers, Woolies and Endeavour we're talking about getting clients set.
And I guess those companies like Big W are actually getting into knockoff type brands. So you go in there, you see boots that look a bit like a Blundstone, but they're not Blundstone. And sure, I guess that a lot of people will buy those and might dress it up with an expensive T-shirt, but the other stuff is reasonably cheap. I can see that actually happening. Probably you would be a fashion icon in the stockbroking world, wouldn't you, mate?
Just with the tie alone,
Yeah.
So.
Ties are popular now, aren't they? All right, let's go to your best. Your sell. What have you decided is not going to be on your radar screen?
Yeah. So talking about that resource side of things and talking about how the second half is going to get a little bit tougher, we need to be careful. I think alumina is one of my big sells that I've got at the moment. We've been working that through over the last couple of days, talking to clients about alumina. Most brokers got sort of price targets around the $1.50. It's currently sitting at $1.55. They've said to the market that the second half is going to get a lot tougher. They've also said costs are rising in WA and in the different regions, so cost pressure is also rising. Plus also, I don't think, and someone might quote me if I'm wrong here, but I don't think they quoted a dividend this half.
Okay.
Again, that is a big thing for alumina because it has been a very good dividend paying stock. So I'd just be cautious on alumina, and I don't think you need to be there.
Okay, one last one before I let you go. A number of years ago when the old Sky Business Channel was on, you and I did an afternoon session once with James Dagger Nixon, if I remember rightly.
I remember old James,
he asked us the stock that we liked for the year ahead. And I remember going for Xero at a price of about 35 or 40. And you actually gave me a compliment, which was unusual for you to praise me. And of course, it's still around 75 or something like that, and it's gone as high as 120. I was looking like an absolute genius then. A lot of the people I interview still like Xero this year. They think it'll come good. What do you think about Xero for 2023?
Yeah, look, stock Xero's up today around 5%. I think that potentially the market is looking through some of those results, and in that tech space, as we previously mentioned, there was some upgrades to the sector. So I think that's really positive. I think Xero is a very, very intelligent business. They know exactly what they're doing. They know how many customers they're looking on their platform. They know it's all about getting market share in the US and the UK, and I think that's just what's really been quite slow for them going forward. But these guys, I use Xero in my business. I pay a small monthly fee. Even if the economy is really bad, I'm still going to have to pay that fee because that's what the accountant now uses to then do all the taxes for my business. So I really don't see there much pressure on something like a Xero when things are really, really tough. But, if we start to see interest rates leveling out this year and potentially even coming down a little bit, that will be a huge impetus for the tech sector to get some buying behind it and going forward. And another one that I sort of like, and I know we've talked about this previously, but Magellan came out today with their funds under management. Yeah. They only lost 800 million this quarter. So I think that's it's an amazing step because basically it's been sort of $2 billion being sort of every quarter coming out. Yeah. Only 800 million. I think that potentially they've put the finger in the hole to stop the leak. Yep. It's still probably a little bit there, but maybe Magellan has turned a bit of a corner here. I'm not saying it's a screaming buy, but look, again, if it's at $8 something, and if you got $1 or $2 out of it, that's not a bad profit. So that would be something you could do for a longer term as well. And
I know with my financial planning clients, Magellan for 10 years was a great performer, had a shocker last year. Of course, a stock market price is different from what they're actually returning as fund managers, to advise clients. And we're basically saying, give them another year, because I think if the US market rebounds, the kind of stocks they're in, Starbucks, Microsoft, should help their returns, as well as the Chinese stocks like the Alibabas and whatever. So I think they're probably worth another year, and therefore maybe the share price will benefit. But I don't think we're going to see $50 or $60 for quite a long time.
No, I agree with you there. That will be a very long time away. But certainly, look, if confidence does come back and performance does start to come back, inflows start to come back, and this one does look pretty good. Okay, mate. Thanks for joining us. Thanks. Have a great afternoon. Same to you, mate. Adam Dawes from Shaw and Partners. And that was Adam Dawes of Shaw and Partners. Coming up now is ST Wong of Prime Value. Well, thanks for joining us, ST.
No, thanks, Peter.
All right, so this is our first interview for the year. So I thought probably the good question is, what's your outlook for stocks for the rest of the year?
Peter, you always start with the most challenging questions, but let me give you my perspective. Look, the market has started quite confidently this year. And that's been a pretty, in contrast to expectations towards end of last year. So in that sense, the key takeaway is that we're still working through a number of issues, including inflation, interest rates, talk about bear rallies, for example. But, really stated simply, the market is potentially starting to think about peak in interest rates. Certainly moving towards normalization, dealing with the whole specter of potential recession in Australia, which I think will be low as a probability. But at the same time, China is reopening. Corporates in Australia is in a really strong position, especially where cash and balance sheets are concerned. So I think whilst this market will be somewhat choppier, perhaps in the near term, and that's because markets are quite kind of efficient looking at the near-term data. I think as we track through 2023, I'm optimistic on the outlook for 23, and that's where we sit at this juncture. So much more optimistic than where we were at the conclusion of 2022.
Yeah. And it seems to me that if inflation in the US in particular resumes a reasonable pace of falling, the market will like that. But if it remains elevated, that could turn the market sentiment around. Is that a fair call?
I think so, Pete. I think the market's probably starting to discount the probability of inflation coming off, and with that, rates peaking. And as mentioned earlier, the market is quite efficient in factoring in the shorter term aspect. What the market's probably dealing with is really the whole spectrum of profits, and that's potentially linked to the economic cycle. So the debate is moving on towards, are we going to have a soft landing, a hard landing, or in some parlance, no landing in that sense. So we are moving on to, I think, a different set of debate or considerations. But I think potentially the whole aspect of the double I's, inflation, interest rates, will become a smaller factor in driving markets in 2023. And what will be the key to driving markets in 23 will really be down to earnings.
Yeah. Okay. Now, Tom Leeds from Fundstrat, he's a US hedge fund manager. I'm sure you've probably come across Tom. He makes me look positively pessimistic at times, Tom. But he thinks that March and April will be good for US stocks. And he is actually arguing that he believes inflation will show signs that it's cooling in the US. Now, you know, people like you and me, we've been watching statistics for a large part of our working life. They can surprise on the high side, but they can surprise on the low side as well. So I guess if stats are in his favour and inflation does over the next couple of months show some surprising drops, it would be good for the market.
I think as a probability, yes. The fact that the market's been so concerned about inflation and how sticky it's been, any signs on inflation coming on the downside, I think the market will be taking that positively. And we've seen this template over pretty much the last 8 weeks, literally. The market started off January really positive, and that's on the back of inflation, gave some back, and now the market's kind of thinking a little bit more, whether perhaps inflation is going to come off. And we see it in Australia as well, and how the RBA is potentially thinking about things, maybe 25 basis points tomorrow, perhaps 50 basis points. So yes, the inflation factor will be a key driver in the near term. And that's going to cause choppiness, both up and down, in the near term. But what it does is that it sets up a potential economic cycle that will kick off this year into the next couple of years. And that's where we as fundamental investors will be looking out in the next 2 to 3 years for ideas or companies which are going to do well as the economic cycle kicks off again in that sense.
Okay, so that leads me into my next question for you. What are your best ideas right now? If they're ones that you think are going to give you a short-term lift, great, but also you can focus on what you're referring to then, the longer-term plays, because there are plenty of growth stocks and small cap stocks that have been really belted around. And if we do get a rebound in stock markets, I suspect the value stocks that have been doing well will eventually give way to the growth and the tech type stocks. So if you disagree, tell me, but that's what I've been arguing in a lot of my writing.
Yeah, look, Pete, what's been interesting coming through the reporting season just passed is that when I look at my portfolio and the kind of stocks that I kind of gravitate towards, really come down to, I guess, ideas across the market capitalization spectrum. So really on a large cap end as well as small cap end, and I'll talk about the small cap end since you raised it. Let me kick it off with QBE Insurance. The market tends to look at it as, it's a large cap company, so it's not going to go anywhere too quick. It is tied to insurance premium cycle, but also it's been a beneficiary of the interest rates scenario, bond yields scenario going up. And as you know, insurance companies have a large proportion of the earnings in a portfolio. But really, the story with QBE, if you track through the last 18 months, is a story of simplification, risk reduction, and what I think as a fundamental investor 2-3 years out is that this company has the potential to be re-rated. It's trading about 10 times, so just under 10 times next year's earnings, yield about 5%. And as the company simplifies, de-risk, I think it's got a really good chance of being re-rated upward where the multiple is concerned. So, 10 times currently down to up to about 12, 13 times. So that's the upside, and kind of looking at on the large cap and on town. And what's happening in the background? Insurance premiums going up, interest rates going up. That's the tailwind, which I'll take as a positive, but certainly not investing in those tailwinds as a single reason for investing in a company like QB. Yeah. But as we track through the fundamental aspect of small and mid-cap companies, I look at companies such as IDP Education as attractive. So one of the more expensive stocks in the market, growth stocks, if you like, as a category, 34 times earnings, so that's pretty expensive. But as China reopens, as it works through some of its migration and visa issues, I think this company will be really well placed to grow its earnings base in the next couple of years. So the growth we're talking about is not 5%, 6%, 8%, but more double-digit, 10, 20, 30% kind of growth rate. And that's comes with a multiple, and that's why it's called, I guess, in the growth category. Hasn't been doing too well in the last couple of months, but I think it's probably one which I think I'm looking quite comfortably into the next couple of years as earnings growth come through. So these are sort of larger companies that's really doing quite well, looking attractive, QB in a value set. If you look at pure valuations, IDP Education, 33 times, 34 times earning in a growth bucket. But let me conclude with, I guess, a small cap idea, which is not exactly that small, and that's Seven Group. Seven Group has ownership of the Caterpillar franchise in WA, predominantly through the company called Westtrack, but it also owns the Code business, which is a hire equipment hire business, and also holdings in Boral, Channel 7 TV business, and also Beach Petroleum. So a whole lot of, I guess, smaller holdings in a number of sectors, doing really well in the sense that mining is doing well, construction in infrastructure in Australia is doing really, really well. But I think most importantly, Pete, this company has got pricing power, and that's what we like about the Seven Group business in terms of Westtrack and the Coates Hire business. Yeah. So small cap end of town, perhaps maybe a little bit more spicy, but certainly the growth prospect seems really strong.
Yeah, and that's even though they have ownership of Seven West Media, the other company, but its main play has been basically Kerry Stokes looking for mining type businesses, and he's been a very good buyer of stocks when the prices have been down.
Absolutely, that's definitely the key point. So Ryan Stokes, who runs the business now as CEO, has, I guess, proven himself to be quite a value investor. If you recall last year, it bought into Boral. Boral was kind of on his knees where management is earnings concerned, and they kind of engineered a takeover of the business without really paying a big premium for Boral. So a lot of businesses that sits within Seven Group, I think kind of sits within the value camp, but management has the capability and the aspiration to improve those businesses. And as shareholders, that's where the value comes through from a wealth creation perspective. So you look at Boral, we think the next couple of years it's got quite good prospects to improve on its fundamentals, turning around the business. And that's where, as shareholders, we expect to reap the benefits of investing in a company like Seven Group.
And does Westtrack still have the franchise for Caterpillar in China?
No, that's been sold off. Yeah. So that's pretty much all Australian based now.
Okay.
And as you know, Pete, mining has just been continuing to boom from a volume perspective. And that's to the benefit of a company like WestTrac in that sense.
Okay, mate. Thanks for joining us.
Thank you, Pete.
Yeah, well, that's ST Wong from Prime Value. I'm catching up with Ben Finger, who's the CEO of the Haben Property Fund, and they've got a new investment coming out, and I want to talk to him about it so I can fully understand what the project is all about. Ben, thanks for joining us.
Thank you for having me, Peter.
Now, look, I know you guys have been advertising on Switzer Daily, and so I thought it might be a good idea to actually fully understand what you're trying to do. And I can't endorse anybody because,
Sure.
End of the day, you are potentially offering better returns than term deposits, and we know it means that they're more risky than term deposits. You're not government guaranteed. But a lot of people have invested in these sorts of investments like yours, and historically have done pretty well. So, tell us about Haben Property Fund.
Thank you for the opportunity, first of all. So, Haben Property Fund is a business we've been around now for 13 years. The business, Haben being Harold and Ben, my father and myself, we started this together. We started it quite organically. We were doing our own private projects and essentially approached by some friends and family that wanted to co-invest, which for us was a fantastic compliment. And having that in the back of our minds, we decided that made sense at the time to co-invest our money with other people's capital, which would give us the opportunity really to buy some larger assets at better prices than what we'd traditionally be buying when we're competing with a larger pool of people for smaller sized assets. And in going through that sort of exercise with ourselves, we decided that we wanted to focus in on one sector and be an expert in one area rather than try to be players in all sectors.
Yeah.
And so we landed on what we call food and service-based shopping centres for two prime reasons. One, it had a very reliable cash flow being linked to food and services. And the second piece that really compelled us was the fact that they're all underdeveloped sites. And all these shopping centres sit on really large parcels of land, large car parks sitting around them with the shopping centre traditionally in the centre of it. And this land that sits around it, it's all mixed use zoned, so it really gives you the possibility to be able to unlock some sort of upside on the site, and that's by way of getting a planning approval through or a development application approved through on the site for another use, whether it be office or residential, medical. And that doesn't necessarily mean that we need to build it per se, but just by getting the approval on the site, it enables us to get some upside and great value on the shopping centre.
Okay, so can you give us an example of an investment that's like the one we were talking about in the moment?
Sure.
Where what it was like when it started, what did you do, and what was the outcome?
Yeah. So by nature, we're opportunistic. We like to find things where there's an opportunity to add some value. So, a site that I can think of is one that we exited out of a bit over a year ago. We bought in Western Sydney, a shopping centre. It was an unloved centre. Great location, tick, good sized parcel of land, tick, on a transport node. It was right on a train station. But it had really just been unloved by the current vendor, and for us, and because it was unloved, a lot of people passed it up on the market and just took it at face value. We saw a great opportunity there, and as such got it at some great pricing. At the time, we spent many years improving the asset itself, improving the tenancy mix, renewing the length of the leases longer with the tenants, which gave it more of a reliable cash flow for a longer period of time. Improved the experience for the shopper by putting some new and better lifts inside there. So all in all, improved the investment asset itself. But then on top of it, during the tenure of ownership, we got approval for 600 units on the site there. And when it came time to selling the asset, not only did we get the value of the shopping centre, but we got well above the odds on the value, because the incoming purchaser had to pay for the price of the value of those apartments.
And did that purchaser continue to run the shopping centre and then move to start building units on the land?
So that would be the longer term intent.
Yeah,
Absolutely.
okay.
Yeah.
And so invariably then I presume you sell to an organisation that's bigger than you, or else got bigger dreams, is prepared to borrow and whatever.
To that point, 100%. And guys that or companies that are set up to build hundreds of units. We don't consider ourselves to be a developer of hundreds of units. We can add value by getting the approval and the right type of approval on the site.
Yeah. What has been the least successful activity you've done, and why was it as less successful?
Probably the one that comes to mind would be a shopping centre we acquired many years back in Melbourne, and that's not to say that the overall outcome wasn't still good, which it still was good, but in terms of time that it took us to execute on the strategy that we set out to do, it ended up taking longer. And there was a fair bit more work. This was a shopping centre that was really in dire straits, and it did need major refurbishment and a major overhaul. And so we undertook to do that. But because of market circumstances at that time, it ended up being that whole exercise took longer. One of the things that impacted it was the start of COVID as well. It was outside of our control to some degree, and other things that impacted it. Was the banking environment at that point in time as well. They were less likely to lend as much as they wanted to. And for us as owners, we want to deliver always on what we say we're going to deliver to our investors. And if we don't, it hurts us. We have our own money in there like an investor, so we feel it like an investor as well. Often the largest investor in each of our funds. But the way that got delivered, it didn't happen exactly on the time. The returns as such were a little bit lower for a little bit longer. But the final outcome in the end is as good as what we set out. It went in a couple of different twists and turns.
So if someone invests in one of your projects, what is the flow of income coming back to the investor? What's it like? Is it regular payments, or is it a balloon payment at the end? Or?
So I guess, and it's a good question, the key to a lot of these things and why a lot of people invest with us in these investments is they do love the regular cash flow. So first and foremost, putting aside the upside, which really excites us, of course, there needs to be a steady, reliable cash flow, and it has to be a growing cash flow. Because if you think about these investments, when we buy them or when we sell them, what are people buying? They're buying a cash flow, so it needs to be a reliable cash flow coming through. So almost all of our funds are quarterly distributions. They're paid, after right at the end of the quarter on the first day. We have one fund which is a monthly distribution fund, but by and large, the majority of them are quarterly distribution funds, and they're generally very reliable.
And is it purely a function of the rents that are coming in?
Correct.
You guys would have to take your service / profit margin, and the leftovers shared by the investors.
Yeah, correct. And we operate probably a little bit different to a lot of our peers in the unlisted space, in the sense that we have a full operational management team. So everything that happens in shopping centre land, we don't outsource to anybody. We've got the full gambit of management team, everything from shopping centre leasing to marketing to operations. So we manage quite a large team across the east coast of Australia, and then so out of that we manage those assets, we operate those assets, we collect the rent, we pay the expenses, we do all those things that are involved in a shopping centre, and then those proceeds, after those fees are paid to cover our staffing costs, it goes back to the investor.
Obviously, people must say to you, "Well, look, I'm interested," but what kind of return should I expect along the way, and maybe in total when you eventually exit?
Yeah. So we
and be absolutely accurate. It's such an easy question to answer.
Well, look, I can tell you what our hurdle is. When we have our own internal investment committee, which is made up of several people that sit on the board within Haben, and we won't go into anything unless it passes our minimum return expectation. And our minimum return expectation, when you combine, annual distributions, as well as call it an annual capital gain, which is amortised over the investment period, we want to be targeting anything and call it the low to mid-teens IRR return, right? So just say for argument's sake, 12 to 13% IRR is where we like to target it. That's our base case. That's not including the extra value we get from getting a great approval on the site, because we're not wanting to underwrite that. We're saying to the investor, this is the minimum base case. This is what we're backing is going to occur on the investment. And if we get that, then that's a bonus. I can tell you what that looks like only from previous experience on things that we've exited. and we've exited 5 funds to date. All of those funds that we exited, we targeted, the base case IRR of the low to mid-teens, but we managed to actually achieve at the end an IRR average to date of about 24%. So it's been an incredible uplift as a result of getting that outcome, which again, we always say to the investor, please be comfortable with the low to mid-teens. We don't want to guarantee that.
But that is ultimately a big return.
It's a big return,
but
yeah.
It's not a term deposit. You're taking a risk.
Correct, yeah, absolutely.
All right, so tell us about the specific one that you're going to be going into now. This, I presume it's a relatively unloved shopping centre.
Yeah, and look, like all things, timing's critical to getting the right assets. We're in an environment which we've been sitting in for a few years where we're not competing with the large A-REITs, the publicly listed real estate companies of Australia, because they are all dealing with their own issues at the moment. And so that's left a big gap for groups like ourselves to come in and play ball. As well as at the same time, you don't have a lot of offshore companies coming into Australia. So there's only a finite group of players that can buy these things, and we'd be one of those players. And as a result of that, when you have one of these groups that then needs to sell something, we're buying these things at a really big discount. A massive discount to what they would have been valued in their peak value. And a massive discount to what we call replacement value. So the subject property that I'm talking about at the moment is the Forest Hill Chase Shopping Centre, which we're...
This is in Melbourne.
This is in Melbourne.
Just locate it for people who might not know Melbourne.
Sure. So it's about 20 k's from the CBD of Melbourne, so in quite an affluent area.
Is it around the Chanston area?
Yeah, we're about a 10-minute drive, so you're in very good company, just to give some perspective.
Well, it's a very famous shopping centre.
Well, the largest and most famous shopping centre in Australia, and the most valuable shopping centre in Australia. So we're about a 10-15 minute
Is it competing
drive.
with Chanston?
No, we're on the periphery of what we would call competition with that asset. We sit on the periphery of some of the larger shopping centres in Australia, actually, but not really cross-shopping with those per se. By and large, this asset is more of a convenience-led shopping centre, as opposed to Chadstone, which you'd call a destinational outing shopping centre.
So does it have like a Coles or Woolworths or an Aldi or something like that?
Exactly. So to that point, being convenience, it's anchored by all those food and service.
Oh, they're all
there. They're all there.
So it's a reasonably big centre for all three of them.
Yeah. So we've got all three of those. Plus, a big Target inside there as well. Some great mini majors inside the shopping centre. Likes of Rebel, JB Hi-Fi, a small entertainment precinct as well, which serves its local trade area. But really, the opportunities and timing to really execute some things that haven't been done on that shopping centre, which it's well due for. And coming back to that story that I mentioned earlier, one of our successes and one of our other assets, this one too has been quite unloved. It's been through a couple of sets of owners, the last 2 sets of owners that really haven't shown the asset attention. It's due for a massive refurbishment. Which is not complicated stuff, but it's just putting the attention to it and the team to it, which we've set out our strategy on how we want to do it and how we want to execute on it, and really just to improve on what's there, because what you got there is a great big parcel land with a great shopping centre. It's got a lot of the great big anchor tenants in the country here, so and they're already serving their population, but we need to improve that service to the community so that they have a better experience, and then they shop there more regularly, and more people within the trade area
It
shop
seems
there.
to me that what you have to do, and you're implying you want to do, is you make the place more attractive.
Correct.
But I presume your marketing is going to be really important too.
Big time.
So what's going to be the sort of the magnetic marketing strategy for this unloved shopping centre?
So it's understanding who your trade area is, which is the most important, and making sure you're actually getting that trade area. So when we looked at this asset, we did some demographic work straight up front, and we could see that the percentage of Asian-born within that trade area was almost 20 to 30% higher than the rest of Metro Melbourne. Yet when you walk inside that shopping centre, you don't see it reflecting in terms of the people that are in there. And then you look at the tenancy mix that's inside there, and you can see it's actually also not catering as well as it could for that. So it's kind of a two-pronged approach. We actually get the tenancy mix a little bit better first, get more of the right types of uses in there to attract the trade area that we want inside there. And then we do that marketing relaunch, right? And that'll be dovetailed with, you know, a bit of a cosmetic upgrade so it looks and feels better, and people will come back and say, actually, that experience was fantastic. It's got all the things I want in there. It looks, feels great, better than its competitors, and now I'm going to keep shopping there.
Well, people say it's an easier place to get to and get parking, because something a big place is, it's great, but parking is really annoying.
You need to have convenient parking. If you don't have the convenient parking, it doesn't matter what you do.
You definitely won't get men. Men are sharks. We want something, park the car, get it out.
Correct. So this fortunately has a hell of a lot of parking, and it's all around the shopping centre on each of the levels, which is great. But one of the things that it fails to do, because there were alts and additions that were done over the years, was actually navigate the customer well. So when you get into the parking, how do I get to Woolworths? All the signage hasn't been upgraded over the years. So it's things like that that's low-hanging fruit that we can come in there and do that.
Is there a capacity to do, like you've done in other ones, like residential potential?
Yes, and very much excited about that piece on this side here, because we are that close to, you know, the CBD on a parcel of land that's 10 hectares of land. It's next to impossible to acquire something like that in Metro Melbourne. So we think conservatively we should get, during our ownership and approval, of at least 300 apartments on that site there.
But as you say, you might not do it, but that would be the carrot for some other developer to come along.
Correct, to pay that premium.
What kind of time frame are you thinking from start to a situation where an exit might happen?
So we've banked this one as a 5-year timeline. So we intend to achieve those outcomes within a 5-year period. Most of our funds are either 5 to 7 year periods to do those things.
Is there anything else that, you know, a better question I should have asked you, that someone who's, you know, listening to this and say, well, okay, I'm interested, but is there any other question and answer people should hear?
Look, one of the common things that has been asked over the years is, I guess, just the big question about retail and where's retail heading, the impacts of online, and what's that actually meant. And you know, we've been watching this for the last few years across all our assets, and certainly online has had an impact, and certainly online is here to stay. But by and large, where online is really impacting, it's in that discretionary spend, in the fashion, on the online, in that world. When it comes to food service, convenience, those sorts of things, cafes, restaurants, gyms, nail parlours, that sort of centre and that sort of shop has remained and is stronger than ever. And we look at foot traffic data, you know, today compared to in this particular centre, and all of our centres for that matter. And you can see that the foot traffic is still actually growing, and the spend in the centres is still growing.
Does it have a really groovy gym, or is that something that's going to eventually come?
It's got a gym, but not a groovy gym, and that's some work that we'll do on it.
Okay, great stuff. Well, Ben, thanks for coming along. I think a lot of people, you know, are interested in these sorts of investments, but they aren't term deposits, but they are, you know, they offer bigger returns.
Absolutely.
So, great stuff, mate.
Thank you very much for having me on.
Pleasure.
Cheers. It's
Ben Finger from Haven Property Fund. And that's the show for tonight. Thanks for joining us. Remember, if you want to know more about this company and the kind of investments that we talk to our subscribers about, go to switzerreport.com.au. We have a lot of very, very insightful analysts who come up with some very good ideas for your investments. Thanks for joining us. See you next Monday.